Hello, I'm Bridie Barry. Welcome to Market Move. Well, time now to introduce our guest today, who's going to tell us what was moving the markets. Independent investment expert Roger Montgomery from rogermontgomery.com joins us. Good to see you. Thanks so much for coming in.
Thanks, Bridie. Nice to be here.
It's good, but there have been some big swings on the market, haven't there? They're so volatile. Swings of as much as 3%. I mean, what's your take on why the markets are behaving like this?
Well, on the one hand, you see these kinds of moves when markets are at inflection points or turning points. There tends to be a lot more uncertainty around the appropriate level, if you like, or the appropriate prices for stocks when they're at inflection points, because the outlook suddenly becomes clouded for whatever reason. There's more conviction on both sides about what the outlook looks like, and so you see it tends to, I guess, transpire that the prices move a lot in that. That's what we've seen. What concerns me is that in the entire marketplace we're both good quality and cheap at the moment. The rest of the market is either not of an appropriate quality, or if it is, it's expensive, or both. So while I agree with some analysts who are saying, look, this is a classic turning point, we're either going a lot lower or going a lot higher, which doesn't really help anyone, my view is that the market seems to be expensive. So irrespective of the volatility that we're seeing, and we all know what that's caused by, irrespective of those things, generally, while the market is lower than it was a little while ago, it's still expensive.
Yeah, so a lot of people who are trading the markets, or long-term investors as well, would like to know where the market's going, of course.
Yeah.
But I mean, it was interesting because IG market strategist Ben Potter was pointing out that he thinks investors may be becoming a bit more immune to all the worries from Europe, and that we may be witnessing the beginning phases of the market bottoming. I mean, do you think that's possible?
What was his name?
Oh, Ben Potter from IG Markets.
So Ben,
yeah.
so Ben might be right. Or Jim Chanos, who thinks the Chinese property bubble's going to blow up and it's going to hit our miners in a big way, and he's shorting them as a result. Yep, maybe he's right. I don't know who's right. So what I try and do, and what I often suggest investors do is, and you're not going to like hearing this, Bridie, but turn the stock market off and look at business values. And when I do that, I find that business values are lower than where prices currently are. That doesn't mean the stock market's going to fall. Often people mistake, when I say the market's a little bit expensive, they immediately think, oh, Roger thinks the market's going to come down. I don't have a view about where the market's going to go. What I do have a view about is the disparity between price and value, and there is a gap there at the moment. The value is lower. So one of two things has to happen. Either in the half-yearly reports, companies come out with more optimistic statements about their prospects, or they surprise on the upside, and that brings the values of companies, the intrinsic values of companies, up to catch up with price, or the prices drop or go sideways and wait for the value to catch up, if that's going to happen. The worst case scenario is that the values of companies actually declines, and that would mean that the stock market ultimately will probably go down.
Another certainly volatile thing that we've been watching is the Aussie dollar against the greenback. Now, it was interesting because there was a note from Westpac currency strategists saying, look, they're a bit sceptical about the rise that they've been seeing, well, today anyway, saying that it seems to be moving up on lowish volume and stops, and that it's nearing resistance. What are your thoughts on where you've been seeing the Aussie dollar?
Well, I don't look at any technical analysis at all. I don't look at charts or any of those sorts of things. But I do have a view, and my view is that our currency is ultimately tied to the prospects for our resources, and for any resource boom or bust that may occur. So if you believe that the 30 billion square feet of property under construction in China, which is equivalent to 23 square feet for every man, woman and child in China of office space, and I'd argue that every man, woman and China doesn't need, and child don't need 23 square feet of office space. So if you believe that that ultimately is going to lead to sub-economic returns in property, therefore property developers and construction companies are going to not require as much resources to build, to make steel and concrete and glass and all those things that we use for building, and China uses for making buildings. If they don't need as much of that, then that's going to depress demand for our commodities. That's going to depress interest in our commodity companies, and ultimately will depress the dollar.
All right, let's...
If you believe in that philosophy, theory.
Okay.
Yeah.
A lot of viewers would be interested to get your thoughts on BHP and Rio and how you value them at the moment.
Well, look, I've always said that BHP is the better quality company in terms of its balance sheet. So if I had a choice between the two, and I know some people like to hedge their bets and they like to buy a bit of both in case one does better than the other, I understand that. But if I was going to pick one, it's always going to be BHP. Now, the prospects for these companies, based on analysts' forecasts, look very, very good. And if you agree with what analysts are saying in terms of what the profits for these companies are going to be out for the next couple of years, then the intrinsic values of these companies rise a lot. And they're not particularly stretched in terms of prices compared to their values. They're not bargains. You know, I'm not talking about companies that are trading at 10 or 15 or 20% discounts to their intrinsic value. But what these companies are beholden to is what we've just talked about with regards to China. So if that turns out to be a fizzer and China just keeps growing, and demand for commodities continues, particularly coal and iron ore, then I think you're going to find BHP's share price is going to look pretty attractive today in a couple of years' time. If that doesn't happen, and that's the caveat, and I don't know whether it will or won't, well, then the share prices are in fact quite expensive. So it looks cheap on a valuation basis out a couple of years. So the value today is about the price for BHP. I'm going with the one I prefer. The value rises considerably over the next couple of years, but remember that those intrinsic value increases are based on estimates that are not assuming any problems or any speed humps in China.
What are your thoughts on Westfield then?
Well, look, I have to admit today I was concentrating more on the fact that Frank Lowy was ranked the richest man in Australia. So slow and steady wins the race, it seems, doesn't it? But having said that, as I said to you before, I can only find 4 things that are cheap in the market at the moment. So Westfield doesn't appear to be compelling in terms of valuation, and it's not one of my A1 type businesses at the moment. Because so much of its earnings are paid out as a dividend, close to 75–80%, it's almost like a bond with a little bit of growth prospect factored in. But what we've seen is a recovery in a lot of property stocks and real estate investment trusts after the global financial crisis. Of course, many of them diluted everybody. And that recovery has caused many of these stocks to be priced above their valuations based on their business performance. If that business performance starts improving, then we'll see a lift in the intrinsic value for Westfield. But at the moment, it doesn't seem to be particularly cheap.
What do you think of Wesfarmers and Woolies?
Okay, most of your viewers would probably be aware that I favour Woolworths. My valuation for Wesfarmers is less than half the current share price for Wesfarmers. So the share price is $27.70 or thereabouts. My valuation is half that. And less than half that. So people think that that's silly, and I have received all kinds of flack about that. You know, how can you say that, you know, the share price is at $27, how could it be worth half that? That's ridiculous. Something's wrong with your valuation formula. And look, I've received that criticism in the past when Telstra was at $9 and the value was closer to $4. And, you know, the reality is that over short periods of time, prices can completely disengage from values, because in the short run the market's a popularity contest. Wesfarmers has got some momentum behind it in terms of its share price because people like the turnaround story. You know, that's what you just talked about. You're just talking about the turnaround story. So people think, yeah, it's turning around, so that's going to be great for the share price. So they buy the share price, and guess what? It's great for the share price. But the performance of the business hasn't yet caught up to the share price. What we actually need is for returns on equity to catch up. Now, the issue with that is that because people have switched out of Woolworths and they're buying Wesfarmers for the turnaround story, Woolworths is a great business, high rates of return on equity, in terms of business performance, far superior to Wesfarmers at the moment, and as a result, trading on or about its intrinsic value. So, you know, that's pretty rare. It's only happened sort of 3 or 4 times in the last decade that Woolworths has traded at a discount to its intrinsic value, and it's right on it now.